How you doing on this wonderful day? Today I will be discussing PE ratios. Your stock market suggestion advisor. You want to say it? I do have a disclaimer. This is not stock market advice. This is strictly for. I'm not a fiduciary, so this is just strictly for people. These are my opinions. These are it's for people who want to learn about the stock market. First of all, what are PE ratios? Basically, a PE ratio is a stock valuation measurement that compares a company's stock price to its earnings price. So, PE ratio is what I use a lot. So that's good to know. Also, P ratios are what the experts use to figure out whether a stock is cheap or overvalued. So a lot of people think that a cheap stock has to do with its stock price, but in fact, when experts talk about how cheap a stock is, they are referring to the company's valuation. So I don't know how many of you all watch Shark Tank. Shark Tank it comes on CNBC. We call this the Money Channel. It comes on CNBC around 7 p.m. Eastern time, and basically it has a bunch of investors there, from Mark Cuban, the owner of the Dallas Mavericks, to Mr. Wonderful. I forgot his name. The owner, he used to be the owner of Fubo. Draymond, I think that's his name. So they, excuse me, investors will come to them asking for money, and then the have the judges, which are Mark Cuban and all these other guys, they will decide whether they want to give the money based on the valuation of the company. So you'll hear these words. You'll hear these words a lot, but basically that's what a PE ratio is. So let's get into it. I will discuss. Define a PE ratio. You will take the stock price of the company. So let's say the company is trading at $124 a share. Okay, so $124 a share, and you would take the company's stock price and divide it by the company's earnings per share, and this will find the PE ratio. So let's do some quick math. Let's do quick math. Let's say a stock price is traded for. Let's just make it easy. Let's say the stock price is 100 dollars a share, 100 even. And let's say the earnings per share is like four. Earnings per share. I'll show you what to find earnings per share in a few. Let's say it's about four. So $100 is the stock price. Four is the earnings per share, and you will get, it will be 25. Um, Usually a good stock price, a good PE ratio is they said it should be like 15, 20, 20, 15, 20. They said if you find one under that's about 10 or under, it's a steal. So experts use this to determine whether they want to buy the stock or not. This shows how well a company is managing their money, because they say, okay, the stock price is here, and the earnings per share has to do with um, how much money the company is making or giving their investors. You know what I'm saying? So however much a company is making, they can decide, they give their investors a portion of that money. Okay. So let's go here. Let me see if I can share my. I want to share my screen, but for the sake of time, let's just go here. I'll tell you what a I will tell you what earnings per share is and how to find it. I want you to be clear on this. In your journey as investors, I want you to be clear on this. This is a very important tool. So earnings per share. Um, what is earnings per share? I'll tell you how to find it in a few. So earnings per share is calculated as a company's profit divided by the outstanding shares. So again, earnings per share is calculated as a company's profit divided by the outstanding shares of its common stock. The outstanding shares is how many shares they can put out. Like every company has a certain amount of shares that they can have that the SEC, the Securities Exchange Commission, said that they reported to the Security Exchange Commission. They can have only a certain amount of they can only have a certain amount of stocks. So let's say they had 1 million stocks. So once the 1 million stocks is going, they have no more stocks to give to investors. So that's what outstanding shares is, and I'll go over this stuff more in my Patreon. I put in a link at the bottom, and also if you guys want to donate, you guys feel free to donate. I'll put my Cash App at the bottom. So again, the PE ratio is the price of the stock divided by earnings per share, and you can find earnings per share when you go to listen to me www.finance.yahoo.com. That is how you type it in. Yes, it's yahoo.com, but when you type in what I said, www.finance.yahoo.com, you will find it. Or you can just go to www.yahoo.com, and once you get there, go to the finance section, and it'll take you to the place where you can put in ticker symbols. Ticker symbols are the abbreviation of the stock. Okay. What else I wanted to cover? So yeah, so that's what experts use when they determining whether a stock is overvalued or undervalued. So let's do some more. And I'm gonna teach all this in my course. So right now, it's just doing this so I could get you all in the game. I want you all to get in the game of the stock market. Please get in the game. So what else I got here? Lastly, what I want to tell you all that remember, there's a big difference between trading and investing. A lot of us getting confused. They think trading and investing is the same thing when it is not. Okay, this is one of the most important things that you will learn or you need to remember in your journey as a stock market investor. Okay, I'm gonna tell you the difference between a stock market investor and a trader. So, okay, let's find out what is a trading. What do they mean? Okay, investors take a long term approach to the stock markets, and it often refers to retirement accounts. So whenever you hear about these mutual funds, pensions, 401ks, all etc., these big institutional investors are investing your money, and they're in it for the long run. They are not trading your money. Trading is what is trading? Trading involves short-term strategies to maximize returns daily. That means day in a day, daily, all day long. People trade into the stock market close, monthly or quarterly. Institutional investors are not trading your money. If they trade your money, oh, we could be in a whole heap of trouble um because they might lose a lot of it. That's why they're in it for the long run. Remember, when you invest in a company, when you invest in the stock market, you're investing in a company. A company needs your money so they can use your money to grow their business, make investments and back into the business, etc. You know what I'm saying? So they're basically using your money. That's why a lot of private companies they do the same thing, but they're not trading on the stock market. They're just private companies. And I could tell you how to find some of those private companies to invest in at a later date. Or I'll put my Patreon and stuff, my Patreon in the bottom of in the subscription. So um like I said, they're not trading your money. They're investing it. Okay. So let's say this. Let me leave you with this. Investors. Here's another thing. So basically, it's just investors are right. We're riding out the market. So we'll take our short term. We'll take our long term gains. We'll wait it. We'll take the if a stock pulls back some or exchange traded fund. I talk about those later. They're just mutual funds on steroids. If their stock price pulls back a little bit, we're not too worried. Because why? We looked at the PE ratio. We looked to see if the company is managing debt. We check these companies' balance sheets, their cash flow statements, their income statements, and we'll say, okay, this is a healthy company, so they would survive this inflation period, whatever is going on. That's what we use. That's why we're looking at PE ratio. That's what we use when investing in these companies. Okay. So, what else? So, like I said, the people go to the public to raise more money. That's why people go to the public market, which is the stock market, because unlike a private investment, you got to go through. They got to see if you're an accredited investor. They got to see. You got to go through all this paperwork and stuff, etc., like that. When you but the exchange you don't. I mean, you could wake up early one morning and just just put in something in the queue, say you want to buy this stock, and then buy the stock as soon as the stock market open. So you can raise more money in a short period of time. That's why a lot of investors, a lot of companies go public, Apple and stuff like that. Okay, so lastly, here we go. It says that that picture this. Okay, investors as a group earn the total global return on capital roughly is $10 trillion annually. So investors as a group are making $10 trillion annually as a group. Traders mostly make money from other traders, but global alpha, which is the net return of all traders, is around $100 billion. 100 billion. So investors as a group, um, their return on capital is roughly 10 trillion, while traders, which have to, um, they make money from each other trading. They trade. They always in the market. They buy low. They buy low and then sell it high. They got we got a sucker here. Um, that's what it is. It's a market. You say, okay, you got to know when to get out fast and when to get out. You got to know the psychology of investing. Of trading. You got to look at we call those you got to look at charts, candlesticks, and stuff like that. So that's what traders doing. They say, okay, look, this much of volume. You got to look at stuff like volume. Okay, this much volume, or the volume decreasing, or the stock going down. I'm gonna teach you all this stuff. So much to learn about this. You know what I mean? So much to learn. So again, investors are getting a return on capital of $10 trillion, while traders are getting they're trading with each other, only making 100 only make up $100 billion annually, which is about 100, which is about traders make 100 times more than, investors make 100 times more than traders. Investors make 100 times more than what traders make because they're trading. There are traders who are doing really good in the stock market, but they're on only a handful, and they got a lot of money, and they sit there and watch charts all day. You don't have to do that. You want to invest for the long term. Warren Buffett, which is a well-renowned stock investor, says that it said that the stock market belongs to the patients. Patience. Patience. Have some patience. Have some patience and choose your stocks wisely. Choose your companies wisely. This is not a casino. And later on, I'll tell you some tips on how to make money with trading. But right now, this is what it is: PE ratios and the difference. Okay. What else? So that's all I have for you all. I hope this helps. I will be putting more into the I'll be sharing my screen more and stuff like that. But my Patreon will be at the bottom of this, and you all can have a nice day.